talk about some of the stuff you guys have been writing about, and I want to start with an issue that you guys seem to be in pretty significant disagreement about, and this is the whole notion of the dividend bubble. And Morgan, we've talked about this before.
Yep.
But Matt, you just wrote something recently where you basically said, no, there's no dividend bubble. Why do you think that?
Well, part of the reason I think it, and Morgan will appreciate this, is if you actually look at the data, the way that dividend stocks have performed over the past few years versus the rest of the market, particularly within the S&P 500, the evidence just isn't there that there's this widespread bubble among dividend-paying stocks. Some of the stocks have gone up, some have gone up a lot, and so you have individual stocks that are maybe overpriced now, but I don't see a widespread bubble among dividends. And
yet, Morgan, we see companies just amassing greater and greater amounts of cash on their balance sheet.
Yep.
Certainly there are companies that get rid of that cash by making bad acquisitions, but more and more it seems like companies are just returning that to shareholders in terms of dividends. Why do you take the opposite view from Matt?
Well, I think in terms of dividend bubble, the word bubble is probably not appropriate here. I've used it in the past, and it probably wasn't the right word to use. I think more.
What would you use instead?
I think more of what it is that you have dividend stocks in general that are fairly high priced, which is going to subtract from future returns. Not necessarily a bad thing. Most of the stocks I own are high dividend paying stocks, so I own them myself. But when you look at it in terms of future returns, it's probably a lot lower than most people think. So right now, bonds yield next to nothing, cash yields next to nothing, and really dividend-paying stocks are some of the only areas that you can see that you can get yield on a widespread basis, like Matt said. It's hard. There's some overvaluation there, but it's not too bad. But there are specific stocks that have attracted a substantial amount of interest lately, and their prices have been pushed up to levels that will not be kind to investors in the future. A few names: utility stocks like Consolidated Edison and Southern Company are pretty pricey. The big telecom stocks like AT&T and Verizon are pretty pricey. The big tobacco stocks like Altria and Philip Morris International look pretty pricey. Not necessarily a bubble in the sense that these stocks are going to crash 80% in the terms that we usually think of a bubble, but in the sense that future returns over, say, the next 10 years will, I think, be lower than many investors expect they will be.
Matt, what do you think? I mean, I'll turn to you for rebuttal.
I think there are two major points here. The first one is that Morgan just likes to disagree with me no matter what I say. The second thing is that I agree. There are, of course, you can pick out some stocks that are high that probably won't have particularly attractive returns going forward. I think it gets dangerous when we start using that word bubble, and that's the big thing that I'm railing against. And I actually wrote an article maybe last year at this point that there's a bubble in bubble predictions. I think we love using the word bubble now, and when it comes to dividends in particular, I mean, if you think about the dividend, you go back decades, and this is what people wanted from stocks, was dividends. A company makes profits, and what happens? They give it back to you through dividends. And then we lost sight of that over the past 20 years or so. So the idea that anybody would be talking about, oh, we have this bubble in dividends. No, it's more like people are getting back to this is what owning a stock is about, and I think that's a great thing.
As a general rule of thumb, whether or not you think there's a bubble or whether or not you think that there are specific stocks that, to your point, Morgan, are just getting too pricey. As a general rule of thumb, is this one of the best moves that management can make? Because we've talked in this room before about things like share buybacks and how you look at the data and a lot of companies just get that wrong. A lot of management just mistimes that. It seems like paying a dividend is kind of hard to screw up.
The evidence that backs that up is there's a lot of it, and it's pretty unmistakable. There are really three things that management can do with cash. They can pay out a dividend, they can buy back shares, or they can reinvest it back in their company. Or I guess four things they could also do. They can buy other companies with it.
I was going to say, as someone who's a longtime shareholder of Microsoft and Cisco systems, yeah,
right.
Companies can also make acquisitions that are akin to lighting money on fire.
Right, exactly. So of those four things that they can do, paying dividends is unmistakably, if you look at history, and there's so much academic data on this available, is easily the single best thing that management can do for shareholders for long-term returns. The top stocks to own over the last 50 years, when you look at the really long term, are invariably companies that pay high dividends. The single best stock to own over the past 50 years was not Microsoft or Cisco or Walmart. It was Philip Morris Altria. And one of the reasons that is because the company is entirely dividend focused. That's all management focuses on. They pay out the majority of their earnings in dividends.
One company that recently started paying a dividend is Apple, and yet despite the dividend, despite the run that the stock has had, this amazing 15-year run, Matt, you recently wrote, doesn't interest you as a stock. Why is that? Because we've had plenty of people here at the Motley Fool say, forget the run-up of the stock. When you look at the valuation, it is still not an expensive stock.
The valuation actually looks really good right now, and I'll be honest. Up until recently, I had an iPhone since the very first iPhone. I've been using iPods since the very first iPod came out. Apple's in a very tough business, though. Apple's not in the phone business. It's not really in the computer business. It's in the cool business. They're selling wow, and they've done that really well. Unfortunately, that's a tough act to keep up. And I think about companies like Sony. When I was younger, you didn't buy electronics if it wasn't Sony. More recently, you had Research in Motion, and people laugh at that now. But I remember when I was using the first BlackBerry, people would grab it and say, "This is great! Wow, this is amazing! This sends email," And Apple has a very tough act to keep up, and I don't know if it can do it.
What's really tough in with industries like that Apple is in is that they really have to reinvent themselves every 2 or 3 years and come out with new products that keep people excited. And the odds that one of those future reinventions will not live up to past expectations is very high. And that's why, like Matt said, you have so many companies like Sony and Research in Motion and Nokia that go from great heights to great lows very quickly. And really, I think when most people are thinking about investments and stocks, they should look for companies that will prosper for decades to come, and not just quarters to come or years to come. So if you think about a company like Procter & Gamble or Colgate, the odds that 20 years from now we'll still be using the same toothpaste and that Colgate-Palmolive will still have a big share of the market are very high. The odds that 20 years from now Apple will still be the dominant consumer tech company, maybe it'll happen, maybe it won't. There's a lot of uncertainty there, and I think that's one of the big reasons that Apple's valuation looks fairly low is because there's a big question mark over what happens in the future, whether they can still keep coming out with great products every year.
Does the amount of cash they have on the balance sheet give you guys pause at all? Because I hear everything you're saying, and their luck, or whether you believe people make their own luck or not, their luck will run out at some point. They will have a miss. They will, we had the whole thing with the maps recently with the iPhone 5. That seems more like a speed bump than anything else in terms of its long-term effect on the company. But even when you factor in the possibility that they will have a miss of some kind, a big miss on a product, they've got all that cash. It seems like they can weather a couple of misses.
That's certainly true. The other side of that is when you have that much cash, the pressure to do something big with it grows, and when you have pressure to do something big, you get some bad outcomes usually. So it was really the same situation with Microsoft last decade. They had more cash than they knew what to do with. They gave a lot of it away in a one-time special dividend. They also used a lot of it on buybacks at prices that were not favorable compared to today's prices. They also used a lot of it for some sketchy acquisitions that don't look great anymore. So really, usually when the market is valuing companies that have a lot of cash, like Apple, they put a discount on that cash. Reason being is because the history of companies blowing cash on bad acquisitions and bad buybacks is pretty high. So.
Transformative is the word to look out for there. When companies start to struggle and they have a lot of cash, you will hear that they're doing a transformative acquisition, and usually that means a large acquisition that they haven't really worried about valuation on. So if Apple starts talking transformative acquisitions, that is the time to cut and run.
Okay, good red flag to watch out for. Just in the couple of minutes we have left, we're coming up on earnings season. What are you guys watching, whether it's a company, an industry, a trend? What are you watching heading into this last earnings season of 2012?
I'll tell you what, I'm actually really interested to see the continued progress that Bank of America makes. This is a bank that, I mean, they've made so many mistakes, but a lot of those mistakes were driven by a past CEO, Ken Lewis, who, speaking of transformative acquisitions, Ken Lewis loved to make acquisitions. And during the meltdown, he made what are probably two of the worst acquisitions of all time, Merrill Lynch and Countrywide. The new CEO there, Brian Moynihan, he's been doing a lot of good things, and I like what I've been seeing there. So I'm interested to see what they come out with.
I was going to say, aren't shares year to date, aren't shares up something like 60% for Bank of America?
Shares have been doing pretty well, and yet the valuation, I mean, if you're looking at Bank of America on a historical basis and what it's traded at, it's still trading at a pretty low valuation.
Morgan, what are you watching as we head into the last earnings season?
So really two things. When I look at the S&P 500 as a whole, sort of the whole market, profit margins right now are at or near an all-time high. And that's one of the reasons the market has done so well over the last couple of years, and why earnings have done so well, is that companies are squeezing more profit out of every dollar of sales than they ever have. There's ultimately going to be a limit to that, to how much they can do, and profit margins will top out, if not fall. If profit margins do start falling, the only way that companies will be able to grow earnings is through increased revenue. And that's really hard to do when the global economy is as slow right now. So that's one thing I'm looking at. The other thing I'm looking at right now is earnings in the housing industry. There's a pretty clear bottoming and comeback that's going on in the housing industry. And a lot of home builder stocks, a lot of housing stocks that have just been pitiful over the past 5 years are really starting to make a strong comeback. So that's the other thing I'm keeping an eye on. In
terms of the home builders, any in particular that you're keeping your eye on, or just the whole group?
It's really hard to pick a good home builder. There are a few good names that are well managed. I tend to look at it as a basket of home builders.